Welcome to episode 1 of the Investor's Guide to Battery Materials, which is going to be a regular series providing both private and professional investors with all the information that they're likely to need in order to help them invest in the world of battery materials. Given where we are in the battery materials cycle at the moment, I've decided to start with an explanation of the issue of operational leverage as my first topic, because it's a subject that many private as well as professional investors get wrong. Before we start, I'll just give you a quick introduction. My name is Matt Fernley, and I'm Managing Director of Battery Materials Review. I've been an equity analyst specializing in the mining and basic materials sector for over 20 years. During that time, I've been both a broker as well as an investor, both professional and private, and I've written a number of primers on various aspects of the mining sector to help explain them to investors. I started Battery Materials Review 3 years ago as a one-stop shop for everything investors and companies would need to know about what's going on in the wider battery and battery materials sector. I'd also like to specifically thank this edition's sponsor, which is Cornish Lithium. Cornish Lithium is an innovative exploration and development company focused on the environmentally sustainable extraction of lithium from geothermal waters and hard rock sources in Cornwall in the United Kingdom. The company has secured mineral rights over a large area and uses modern digital technology to combine large historical and contemporary data sets, allowing reinterpretation of technology metals potential. It is a private British company headquartered in Cornwall and enjoys a strong relationship with both local and national government. So first of all, just to discuss why I opened with this topic. I think that it's fairly clear now that we're moving into an upcycle in terms of battery material prices. And I think this is an important topic because a lot of investors pick the wrong type of stocks to play in an upcycle. And I say this because if you look at how material prices themselves and different types of stocks perform into an upcycle, they tend to perform differently. On this chart, I'm plotting LME copper prices versus two different baskets of stocks between January 2003 and December 2005. Now, I've picked this time period because this is a period when the market started to realize how significant the Chinese fixed asset investment event was likely to be for industrial materials demand. And I believe that that secular demand event holds many similarities to what we're likely to see in battery materials over the next few years. So if we look at performance, in an upcycle, you may see the materials price, in this case copper, rise 2 to 3 times from its trough level. That's perfectly reasonable for a commodity or material upcycle, and I think that holds true whether you're looking at LME copper prices or high purity manganese or spodumene concentrate or lithium carbonate, basically any of those things. Then I've plotted a couple of equity baskets, and I'm not going to say what's in those baskets for now, but you can see that they have very different performance characteristics. While basket A outperforms the material price, it's in turn massively outperformed by basket B. If you're an investor, surely you want to be invested in basket B, wouldn't you say? But what is basket B? What are its constituents? Now, moving on to the next slide, I just want to give a quick introduction to how analysts value material stocks on a short-term basis. So just to explain, there's 2 different ways that analysts look to value mining stocks: near-term valuation and net asset value. The net asset value approach, or NAV, uses a discounted cash flow analysis to value a company's or a project's cash flows over its entire operational life. While it's a great tool to understand what a company's full value is during an upcycle, it's not great for points of inflection, which is where I think we are now. For shorter-term horizons, analysts tend to use earnings or profit-based multiples, normally based on current year or year-ahead profits or cash flow. So let's just explain this using the example here. We have 2 companies. They've each got a share price of $100, but they've got different earnings. So for instance, company A might have earnings of $20 and company B might have earnings of $50. Now we divide the price by the earnings to get a multiple. In this case, you can see that company A is on a higher price earnings ratio of 5 times versus company B on 2 times. And basically from that, we can interpret that company B looks cheaper than company A because it has a lower price to earnings multiple. But if we increase the earnings of company B, but leave the multiple the same, then the share price needs to increase. In occasional cases, if the earnings increase, the multiple might erode, but generally, eventually, the stock market will pick up on the fact that the company has got higher profits and the stock price will go up. So what we're saying then is that in the stock market, a company's profits are correlated with its share price. And this is a key aspect when we talk about operational leverage. So moving on, now I want to talk about higher cost producers versus lower cost, because this is at the crux of operational leverage. If we look at the example here, I'm looking at two stocks with different operating costs at a constant material price. And you can see that a high cost producer makes substantially lower profits than a low cost producer at the same price. So if the unit operating profit is higher for the low cost producer, then the share price of that producer should be higher based on what I've just talked about, shouldn't it? Well, yes, but only in a constant price environment. But let's look at a rising price environment. The chart on the left is the one from the previous page, but now let's look at what happens when the material selling price goes up 25% to $500 a ton. Well, the high cost producer has got a margin of $120 a ton, and the low cost producer has a margin of $200 per ton. And again, you look at that and you go, well, the low cost producer's got a higher profit. Therefore, it should trade at a higher share price, shouldn't it? But the issue that we're looking at here is the growth in profit. And that's what we're talking about when we talk about operational leverage. So let's look at the high cost producer. At a $400 per ton material price, it was making a profit of $20 a ton. And the low cost producer was making a profit of $100 per ton. Yet at the higher material price, the high cost producer is now making a profit of $120 a ton, and the low cost producer $200 per ton. And I think you can see that the low cost producer has increased its profits by 2 times, whereas the high cost producer has managed a very, very significant increase in profit of 6 times. Even though it's still got lower absolute profits than the lower cost producer, its profit is growing faster. And that has very significant implications as to how the share price should behave. Now, another factor that we need to incorporate when we talk about operating leverage is increasing production. So if we look at a new low-cost producer here, and it might have production of, say, 100,000 tons per year at a material price of, say, $400 a ton, which then translates into $40 million of sales. And it might have operating costs of $300 a ton, which means that it's got an operating profit of $10 million. Now let's look at a second year on a constant production basis, but with a higher selling price. So here the sales rise to $50 million, the operating cost is constant, and as a result, the operating profit rises to $20 million, which is doubling, as we saw in the previous example. However, if we now factor in rising production in year 2, we see even more operational leverage. So the material price stays the same, $500 a ton, but now sales at 150,000 tons per year are $75 million rather than $50 million. Operating costs stay the same, which means that operating profit is now $30 million, and your growth from year 1 to year 3 is 3 times rather than 2 times. So you can see that having a higher production has quite an impact on profit growth. Now, if we then move on to a higher cost producer, this is exacerbated. So for year 1, all of our assumptions are the same as before. Operating profit is $2 million on a $380 per ton operating cost and $400 per ton selling price. Then in year 2, as per the previous example, the selling price increases and the operating profit grows 6 times from what it would be in year 1. But now, if we increase the production, you can see that the operating leverage really starts to come through clearly in this calculation. The operating profit at a higher production rate is now $18 million, up from $2 million originally in year 1, which is a 9 times increase. And if you contrast that with the increase in operating profit for the lower cost producer, you can see that the higher cost producer with production growth is even more operationally leveraged to the price than the lower cost one. So that's the crux of operational leverage. Producers with a higher operating cost and/or production growth are much more operationally leveraged to rising material prices than low-cost producers are. Now, before I conclude, I just want to have a quick word about costs, and more particularly, the relationship between prices and costs. I just want to flag that high-cost producers tend to cut production when prices are low because it's not profitable for them to operate. In a low-price environment, higher-cost producers will try to focus on high-grade areas as their deposit and produce less so that they can match supply with demand. But the issue for mining companies is that fixed costs are a significant proportion of costs in the sector. So that might impact a company's profitability, both in the down cycle and in a recovery. So just to give an example here, looking at a company on 100,000 tons per annum output, and then at 200,000 tons per annum output, you can see that the variable cost on a dollar per ton basis is exactly the same at $100 per ton of output. But the fixed cost component is much higher for 100,000 tons per annum output than it is at 200,000 tons per annum. In fact, it's twice as high. And that makes a significant impact. So as a producer comes into a rising price cycle and they're able to raise production, it should result in a rapid fall in their unit cost per ton. Now, another aspect which is very, very important in up cycles for material prices is exchange rates. This is particularly important for producers outside US dollar denominated regions. And since in battery materials, a good 80 to 90% of production comes from outside the US, it's important to understand this issue. Generally, you'll find that reagents and consumables and labor costs are in local currency terms, but most material prices are actually in US dollar terms. Generally, not always, but generally, throughout an industrial production cycle, local currencies tend to strengthen against the US dollar. And that means that the operating costs of companies tend to rise compared to their revenue in US dollar terms. So just to look at this example, for a company with an operation in Australia, US dollar denominated costs of a company, and that might be things like freight and transportation costs or imported product costs, may be $150 a ton. Now, if we look at local currency costs, at the lower exchange rate of the Australian dollar, the local currency costs are lower than they are at a higher exchange rate. And that impacts the profit margin of the company. When the Aussie dollar is weaker against the US dollar, the company has a higher margin than when it is stronger. And what we tend to see in the industry is that as costs creep up, it pushes material prices up as well. If companies aren't able to conserve their margins, then they will cut production. So what we see in practice is that companies tell their consumers that they'll need to pay more, otherwise they don't get a product. Or the product goes to someone else who will pay more. So I just want to highlight in this section that cost and revenue relationships are not constant throughout a cycle. And now, if we come back to the chart I showed at the beginning, I've labeled the different baskets. And you can see that the basket of high cost or more operationally leveraged producers in that 2003 to 2005 upcycle went up by 8.5 times over that 3-year period, whereas the low-cost producer or less operationally leveraged basket only went up 4 times. While it beat the copper price, it only just did. And that's the key issue. A lot of investors in an upcycle will buy low-cost producers because they may be making more money, or they'll buy diversified miners because they have world-class assets. But in fact, the stocks that will do the best in an upcycle are the ones with high-cost assets that are more operationally leveraged. And I know that if I'm the one who's investing, I want to buy the stock that's going to go up 8 times, not the one that's only going to go up 4 times. So thanks very much for listening to this presentation. If you want more information, you can listen to our Recharge podcast at the address below, or you can subscribe to our monthly journal at www.batterymaterialsreview.com. Or you can tune in to more of our Investors Guide series via our YouTube page. If there are any topics you'd like me to discuss in the future, please leave a comment on the YouTube page or drop me a line via the Contact Us section on the Battery Materials Review website. I'm Matt Fernley, editor of Battery Materials Review, and goodbye for now.